Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about U.S. government debt, both from the perspective of an investor and from the perspective of a government, a citizen of that government, and a taxpayer paying taxes into that government system. From one perspective, as an investor, interest rates are a little bit higher now, and that's pushed down the values of bonds temporarily until they mature. But it's also given us an opportunity to reinvest new money at higher interest rates, both over the short term, perhaps through T-bills, and over the long term through inflation-protected securities or longer-dated U.S. bonds. Now, from a taxpayer's perspective, we're borrowing a lot of money every year, more than the revenues coming in through tax receipts to the U.S. government's coffers. And a lot of people around the country, myself included, are becoming concerned that we're spending too much relative to the revenues coming in, and that our total aggregate level of national debt is growing at an unsustainable rate. So we talk about these dynamics, how they play against each other, that is, from the perspective of an investor and the perspective of the government, in today's episode. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. This week on the show, I would like to talk about U.S. government debt. U.S. government debt for investors for a long time has been considered really, really boring when compared to other stuff that you might invest in. I find government debt extremely interesting because U.S. government debt and really the U.S. dollar is what that means at its core is just sits at the nexus of the financial system and capital markets in general. When I say U.S. debt, there's a lot of U.S. dollar denominated types of debt backed by the U.S. government that I'd like to talk about today, both from the perspective of us as investors. Does it make sense to consider adding or subtracting allocations to U.S. government debt based on what's going on right now with the economy, with the inflationary environment that we're in, with the growing level of federal debt in general? Does that mean that the government might be less likely to pay back our debt? And also from the perspective of, hey, interest rates are a little bit higher now. Why don't I just go buy some T-bills with some of my idle cash and get a much higher interest rate than what I can get on my savings in the bank? And that's a pretty good proposition for a lot of people for a lot of reasons. So I'd like to cover U.S. government debt in general, in addition to a few other types of issues, because we're at a point now where the economy seems to be somewhat resilient. We got a piece of data released today. The jobs report came out that showed that we added a lot of new workers to payrolls across the country. That's generally good. The stock market liked that, and as I record this, the stock market closed higher on the day than it did yesterday because of that news. Bond yields went up as well. And all this means that it's slightly more likely that the Fed will increase interest rates later in the year. Whereas if the jobs number was flat or not as positive, if it actually fell month over month, then that would be more likely that they do not increase interest rates because it means the economy is not overheating as much as it might otherwise be. So today's episode is all about government debt. As I said, I find this stuff super interesting because as a citizen of the United States and a taxpayer, I care about the level of national debt that we have. You may or may not know that our national debt level is growing very, very rapidly. And you may or may not know that 31% of all of our federal debt, which is like $7 or $8 trillion, is going to mature in the next 12 months and need to be refinanced. So this puts us in a little bit of a precarious position as citizens of the United States and holders of US dollar denominated assets, and potentially as investors in US government bonds on top of that. So I'm going to go over a few points of how all these things play together, what's going on from the perspective of the U.S. Treasury and investors both here and elsewhere in the world right now. So the first topic I wanted to cover is using T-bills as an alternative to cash in your bank account. And this topic of what we wanted to cover today is probably the shallowest and most benign, but it's a pretty easy one to cover. And I bring this up because I had a meeting with a client here recently. They said, hey, I've got this cash. It's at Bank of America. They're paying me like 0.01% on my savings account, believe it or not, even though interest rates are higher than 5% right now elsewhere. They're getting nothing on their savings. So they said, well, I want to get a better interest rate. What should I do? And we went over the options. The options are to maybe take it and buy a money market mutual fund, find a different bank that's yielding more. We have a setup through our firm called Flourish, and right now they're paying 5% in a high yield savings account that's, for a no fee kind of account that's pretty attractive. But then she suggested, well, why don't I take that cash and go buy some short-term T-bills with it? And that is the best option if you're in a position of trying to get more yield on your cash and you're comfortable managing this actively every week or every other week. The way this works is the U.S. government is always borrowing money to finance their operations. And as I was just talking about a minute ago, the bulk of the outstanding federal debt is over longer terms. 31% of it is over shorter terms. And that's the portion that's going to mature at some point in the next 12 months. So when the U.S. government needs to borrow money, they go to the markets, they issue bonds either over 2-week or 4-week increments, 60 days, 90 days, maybe 5 years, 10 years. Sometimes they go all the way out to 30 years. And you can participate in these auctions. You can buy T-bills directly from the U.S. government if you want to. One way to do it is you log into your brokerage account and you can buy a short-term U.S. note through your broker, but you can also go to the Treasury Direct website and buy them directly from the U.S. government. And that's what my client decided to do in this circumstance. She had extra cash. It wasn't yielding anything. Well, right now you can get about 5.25% per year if you're comfortable dealing with the really crummy Treasury Direct website and managing this actively on your own. What that means is that you log in, you create an account, you send cash from your bank account over to this Treasury Direct site, and then you purchase T-bills that will mature at some point in the future. If you purchase them directly from Treasury Direct, you're probably buying 4-week T-bills, meaning that you give money to the U.S. government via T-bills, and then you get that money back plus a little bit of interest 4 weeks later, at which point you can roll the balance over and buy another 4-week or maybe another 60 or 90-day T-bill from that point on if you want to. So it takes a little bit of effort to continue to keep your cash invested, earning that 5.25% interest rate, but that is the highest rate you're probably going to find anywhere right now. If you're comfortable doing that, then more power to you. Get on the Treasury Direct website and go that route. If you buy T-bills through your broker, you're buying them in the secondary market. So your broker or somebody else out there in the world purchased them directly from the U.S. government, and then they're reselling them through your broker's dealer network for fixed income issues. And so for that reason, you could probably find some that mature next week. You can find some that mature a couple weeks from now because they were issued several weeks ago. And you can purchase them in the middle of their term at whatever the prevailing price is. So you buy some through your brokerage account. You can set up the term structure however you want and pick and choose the securities and the how long you want to wait before you get your money back. In general, you don't want to take too much of your emergency fund and lock it up over a long period of time because that kind of defeats the purpose of an emergency fund. If you have maybe $50,000 set aside that you want to keep there for a rainy day. Well, you don't want to lock it up in an instrument that's going to require you to trade out of it if you need the cash, because you're presuming that, yes, this is U.S. government debt. There are a lot of buyers out there in the world. You should have no trouble selling the debt. There's plenty of liquidity in this type of security. Generally, that's not an issue. But if you go down that road, you're assuming that capital markets are still functioning. And there have been a few circumstances historically where that hasn't been the case for short periods of time. And I'm thinking of the Great Depression, and then back in the mortgage crisis, 2008, 2009, there were periods of time where if you had a U.S. government bond or bill that you wanted to sell, if you needed to liquidate it, it would be at fire sale prices. And that's not the position that you want to be in. So don't do this with all of your emergency fund. Do it with just a portion. But it's a great way to get a whole bunch of extra yield. And every time that T-bill matures, you take the cash, buy another one, maybe another 4 weeks out. And that's helpful to the U.S. government because that's partially how they finance their operations, right? Well, another type of U.S. government debt adjacent to this that we talked about on the podcast and has been real popular over the last couple of years are I-bonds. And with an I-bond, you purchase it direct in the exact same place through the Treasury Direct website. You give the government money. You're limited to $10,000 per person per year. They give you 0.9%. That's called the base rate or fixed rate, I think is what they call it, plus an extra some extra interest related to inflation. And so a couple of years ago, when inflation was very, very high, this was attractive because you could get 7, 8, 9% on that money, which is great. But now inflation is coming back down to earth. We're not quite down to the point that we would like to be, or the point that economists want to be. That's the 2% quote unquote natural rate of inflation, long-term rate of inflation. We're higher than that still. But right now you get 4.3% on your I-bonds. And that's comprised of the 0.9% fixed rate and a 3.4% inflation adjustment. So that rate that you get through I-bonds resets every 6 months. And I believe it goes from May through October, meaning that the end of this month, the end of October, it's going to reset again, and it will probably be pushed down because inflation rates are going down. I think over the last 6 months, the rate we'll see in October is going to be lower than the rate that we saw in May of this year. So I-bonds are not as attractive as they once were. When you buy an I-bond, you're required to hold it for a year. And if you decide to redeem it anytime inside of 5 years, you forego 3 months worth of interest, but you do get your money back. This is not a bond that's a set security that can trade in the secondhand market and is set for a certain period of time. You give the U.S. government your money, and then you can redeem that bond, get your money back at some point in the future. There's not a fixed date where the deal is over and the whole thing just ends. So it's another way that the U.S. government will finance its operations. I don't think it's a huge portion of all the money that they're borrowing. I don't think I-bonds is very much of that, but it's out there. And whereas it was pretty attractive a couple of years ago, it's less attractive now. And we're seeing a lot of people decide to redeem their I-bonds that they purchased over the last couple of years for that reason. It's still not a bad deal. You're still getting, 4.3%. It could be a lot worse, but like I mentioned, we're getting 5.25% in T-bills, and there are high-yield savings accounts out there paying 5%. So if you have I-bonds, just a couple things to consider. Now, another type of inflation-indexed U.S. debt is a TIP, Treasury Inflation Protected Security. TIPS is really the acronym. And it's simply a long-term bond that's issued, long or short-term bond. They're not all long-term bonds. And the rate of interest that you get is based on inflation, just like an I-bond is. But with an I-bond, you're transacting directly with the U.S. government. You have a chance to redeem your redeem your bonds before 30 years are up. There's no set term structure. With TIPS, these are issues with set terms. So it might be a 2-year TIP, might be 5, 10, or even a 20-year Treasury inflation protected security. You usually buy these through the secondary market. And when you do, you get, again, a base level of interest plus an inflation adjustment. And if inflation is high, you get more interest. If inflation is low, you get less interest. But that base rate stays the same. So because that base rate stays the same, TIPS are subject to interest rate or duration risk. And one question we've had a fair amount over the last couple of years is, hey, I own these TIPS. Inflation is high, but the value of the bond itself is down. What the heck is going on? I thought this thing was supposed to be good in inflationary times. And realistically, yeah, they are good in inflationary times, but that doesn't mean that you don't have any other interest rate risk. If interest rates go up, that means that the base level of interest that you're getting doesn't look so good, and it pushes the value of your bond down. If interest rates go down, then now your base rate of interest looks pretty good comparatively, and the value in the secondary market, if you want to sell it, goes up. The other portion of the interest is going to adjust with inflation. So yes, that does benefit you when inflation goes up, but the other side of that is when inflation goes up, interest rates often go up too to offset it, at least short-term rates do, and that can sometimes push the value of these bonds down. So I bonds and TIPS, neither of them comprise a huge portion of all the U.S. government debt out there. Most of the debt that's being issued is through more conventional means that's not tied to inflation. But it's something that a lot of people like to have in their portfolios. We have most of our models at the firm do have some exposure to TIPS securities because having U.S. government debt just makes a lot of sense as a diversifier in portfolios. Not a huge amount of your bond allocation, but definitely some. And over the last couple of years, rates have gone up. That's pushed bond values down. TIPS, just like anything else. Now, I'd like to transition to talking about U.S. government debt from the perspective of the issuer. We have, and this is something else that's been in the news recently. Yesterday, I think we grew our federal deficit by $33 billion, and it was like $100 billion the day before. And they just happened to be days where the government borrowed a whole bunch of money because they needed to finance their operations. And sometimes these debt issues are lumpy. And what I mean by that is if you're a government and the government takes in $10 billion in tax receipts, but the budget for the government is $15 billion for the year, then you have to come up with $5 billion from somewhere. And sometimes you might want to borrow $2 million of that at the beginning of the year, and then another $2 billion in June, and then the final $1 billion in October, something like that. It's not like you're every single day borrowing the exact same amount of money or $5 billion divided by the number of trading days in the year. It doesn't work like that. They issue debt inconsistently throughout the year based on their needs and the market dynamics. Nevertheless, we're growing federal debts rapidly. We have a tendency to spend more than we take in through tax receipts at the federal level. That can happen. That's not a terrible thing in and of itself when it's done responsibly. But we're in a situation right now where both sides of the political aisle seem to dismiss any of the risk that we're presenting to our country. And the risk is this. When we go out there and borrow money to finance our operations, we're borrowing it from investors all over the world, in the U.S. and outside of the U.S. And I apologize if listeners have heard this from me before. I've talked about this a fair amount over the last couple of years. But in the U.S., individual investors like you and me are buying U.S. government debt, either through I bonds or T-bills or T-bonds, either directly or within our 401k plans, maybe. Pension funds are buying U.S. government debt. Other institutional investors are buying U.S. government debt. And then other people around the world, other investors are as well. Sovereign wealth funds, all sorts of institutional investors and individual investors want to hold U.S. dollar denominated debt because the U.S. dollar is the world's reserve currency. If you buy a bond, you give some currency in exchange for U.S. dollars. You use those U.S. dollars to buy bonds. You're pretty comfortable with the idea that the U.S. dollar is going to maintain its value over a long period of time, right? And you're pretty comfortable with the idea that the U.S. government will have the capacity and willingness to pay you back once that bond matures and the deal is over. So the risk of spending too much is that all of a sudden other people around the world are not going to be as willing to lend us money, that there's some limit, some threshold to their appetite for this kind of debt. And we're right now, the amount we're spending versus the amount we're taking in, we're running a pretty hefty deficit every single year. The total outstanding debt is growing rapidly, and we don't seem to have any semblance of interest to pump the brakes on this. And so the longer that this goes on, and we do have some runway here, I don't think this is going to crumble on us tomorrow, but the longer that this goes on, the costlier it is to service these debts. So back to our example, let's say that you have $5 billion that you borrow to finance your government's operation. And that's you've borrowed that $5 billion in a 10-year structure, and you're paying, let's say, 5%, or let's say 5% interest on that $5 billion every single year. Now I have my calculator in front of me because it's too many zeros for me to do off the top of my head. But what that means is that every single year, you're going to have $250 million of interest that you need to pay those debt holders for the next 10 years. And then when the 10 years are up, you have to give back the $5 billion that you borrowed in the first place, right? So now let's fast forward to year two. Unless you change something by increasing the revenues coming in through tax receipts, maybe you make your country more business friendly, maybe you have some kind of policies to bring in international business, maybe, I don't know, you do something to increase the tax rate. You can also increase the rate of tax, right? But if you don't do anything different and you take in 10 billion in year two and then you spend another 15 billion, you have to borrow another 5 billion. So now in year two, you're paying $250 million of interest on the first year's batch of bonds, plus 5% on the next year's batch of interest, right? So the more the debt rises over a year, the longer and longer and longer that you run deficits, the costlier it becomes to service that debt. And we're in a position as a country now where we have a whole lot of debt outstanding. We have the strongest, the biggest, the most resilient economy in the world, and we're very capable as a country of servicing that debt over time. But there is a ceiling, and there is a point at which the interest on the debt itself is more than we can afford as a country. We're a ways off from that, to be clear, but we're getting closer to that issue with reckless abandon. And what happens then is all of a sudden we need to go borrow money to finance our operations. And now all of a sudden people don't want to lend us money anymore because they know that we have all this outstanding debt that we have to pay interest on to service that's going to mature at some point. And they're not as comfortable holding US dollars. They're not as comfortable lending us money. And they might not want to do that. So typically what happens when you look at this historically over maybe the last 500 years or so is when you're in a position like we are as the US government, You can do a couple of things to balance the equation. You can raise tax rates, increase revenue that comes into the country, and you can balance the scales that way. Politicians don't want to do that. It makes them look bad, and if you're a career politician, you've got to get reelected every few years, right? You could also stoke the economy. You can do something to promote entrepreneurship, capitalism, risk-taking behavior, right? If you increase the GDP running through the tax system every single year, that means a wider base of uh, um, sales of goods and services, or corporate profits, I should say, are taxed. And so if you don't change the tax rate, but you have more profits running through it, then that can increase revenue. You can reduce the spending dramatically in this case to balance the scales. Another thing that politicians don't like to do. Or you can print more money. And we're really good at printing money because that's the easiest thing for a politician to do. Of the four decisions, that's the one that is least likely to get you. Um, uh, uh, it's least likely to lose you the next election. Is probably the best way to say that. So I keep coming back to this idea that we're a ways off from the what hitting the fan, and other investors around the world being unwilling to lend us money, and um, to where our debt service becomes too high for us to cover ourselves. But these scales need to be balanced somewhere, and historically, it's been balanced by printing money. We've already done a whole lot of that recently, and that's a little bit of a dangerous place to be in. A more responsible, long-term way to operate here would be to have a political system and elected officials that think of this thing in a multi-decade time span and are able to rein in spending as opposed to do whatever's possible to get them reelected during the next cycle. So that's a problem. On top of the fact that, remember, inflation is here and interest rates are a lot higher. And as I mentioned, 31% of all our outstanding debt, or like $7 or $8 trillion, is going to mature in the next 12 months. When that happens, the US government, they don't have $8 trillion laying around that they can just hand all the debt holders and say, okay, we're going to reduce the debt, we're good, right? They're going to have to roll those over. You borrow $8 trillion through another debt issue, and you use the $8 trillion that come in to pay off the $8 trillion that are maturing. And because interest rates are a lot higher now, the next $8 trillion is going to be a heck of a lot more expensive to service than the last $8 trillion was. So as our level of debt grows and as interest rates become higher, it becomes more expensive to service. And the more expensive it is to service as a percentage of our GDP, the less likely that outside borrower, that investors in general are going to be willing to finance all this, right? So we need to be cognizant of these dynamics. At least I hope that our elected officials are cognizant of these dynamics when making policy and so forth. I'm not optimistic that's the case, but we should be at least aware of it. It comes down to the fact that we have this exorbitant privilege of the US dollar being the world's reserve currency. Anybody transacting around the world, if you want to send ice cream cones from Indonesia to Australia, the Indonesian business and the Australian business might prefer to transact in US dollars because it's the world's reserve currency. It's a stable, relatively stable store of value, despite all the stuff that we're talking about today. So the Australians might buy US dollars. They might use those US dollars to send to the Indonesian company, who then sends ice cream cones back to Australia. It takes the US dollars and then converts it back into their home country's currency. That's true of trillions and trillions of dollars of transactions every single year. And on top of that, people want to access the US market, so they're forced to deal in US dollars. So the more that our debt grows, the costlier it is to service our debt, the more holes are poked in the US dollar's status as the world's reserve currency. And for you and me and our children and US citizens, having the status of the world's reserve currency threatened is a pretty big deal. It becomes a lot harder to operate if there's some other national currency being used, some other country's currency being used. All of a sudden, if people don't want to hold U.S. dollars, then it's a lot more challenging for our government to borrow. It's more expensive for our government to borrow. We're, as a country, very simply worse off. So it's just a very interesting dynamic, because I would almost guarantee that everybody listening to this show probably owns U.S. government bonds through the funds in their retirement accounts somehow. And we're also reliant on the Federal Reserve and the U.S. government to manage our country's revenues and expenses in a responsible way for our and our families and our country's benefit. And the higher that interest rates go, the more attractive it is to buy the bonds, the more expensive it is to issue the bonds. So this is something that we're tracking here, pretty closely. If I were more prepared today, I would have more stats surrounding the level of national debt as a percentage of GDP, and historically where the rubber hits the road as in terms of how much of our GDP can our federal debt be without running into issues. I don't have that off the top of my head, but we're not headed in a positive direction in general. So that's it for today. I hope this was interesting. We'll check back on debt levels, macroeconomic issues periodically. I find this stuff just riveting, and I hope you enjoyed listening to it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.